We're going to start with calculating the monthly cost of working capital by client. Do you actually know how much each client costs you in inflation, interest, or lost opportunity? You probably don't know exactly, and this tool is going to help you quantify it. It honestly makes my head spin trying to understand it. It did for quite a while anyway, but it helps you identify your ideal clients, those you best align with for values, and can offer the best bid too. Not every client should be getting the same bid because not every client costs you the same to work for. This first step helps you know which clients you need to prioritize working on relationships with and their bids so you are more efficient with your overhead, and as a result, you'll improve your win rate and your profitability. If you aren't familiar with the 2024 Subcontractor Market Report, Build polls subcontractors annually, and they found that subcontractors who account for the cost of capital are 11% more profitable than those who don't. So this isn't just a theoretical concept that's wishful thinking. This is what very successful subcontractors do. So let's enter your specific projects with your company specific data. We're going to start with tab number 1, calculating DSO and client costs. DSO, for reference, is days sales outstanding. It's a general accounting language. Just know it's basically the time it takes for your company to invoice to then collect on that AR. Every time you see a yellow cell, those are ones that we're able to edit. We'll start with client number 1. We're going to enter all of your historical data that you have on the average it took for you to collect from the day of invoicing. And if you see this client that I have up here, it's 30 days. Project 2 was 25. Project 3 was 20, etc. The DSO data needs to exclude retention billings. Those skew the data that you actually want fairly significantly. It's important to know the average DSO days fluctuate from project to project from quite a few things that can make your data volatile, and it needs interpretation, not just the values. So a few examples of those are payment terms from the prime contract and your contract. How good is the project manager for the GC on that individual project at making sure that their subs get paid? How well is your team billing month over month and following up on collecting those payments? What size are the projects? What's the project vertical type? And who are the owners? If you aren't already, if you start to track all of the data that granular, it's great to hone in this spreadsheet to be extremely precise instead of plus or minus a percent or more. So I didn't highlight this specifically, but you can actually name every client instead of generic client number 1. So you know who you're talking about later on when you're using the calculator. I'll name this first one ABCGC to show you what that affects on the other tabs. If you want to add more clients, click the column letter of a column that has a client on both sides so the equations update, and click Insert. You'll have to copy and paste the formulas over by highlighting an existing column, copying pasting them into a new column. If you don't have that many, you can also delete them. So after you get all of your data entered, you'll see the green cells below labeled average client DSO. This is historically how quickly invoices get paid by client, number of days. Is your best client who you expected, or is it a bit of a shock? Most people find this is a bit of a shock because the people you like to work with and the people that treat you the best are two different companies. These numbers can range tremendously, and it's important to account for these hard to find costs that can tank our businesses even though we're doing great work. Filling out tab number 1 makes it easy to decide which clients are priority based on actual data of how they treat your business, regardless of all the nice to haves like lunch at the job site, golfing events, or a long history together. If anything, it gives you a platform to open a discussion with the GCs that aren't ideal and give them the information so they can button up on their end. Maybe your favorite client has hired some new PMs that are really skewing their numbers. Now you have an opportunity to prove that to them and tell them why it's going to cost them more to work with you. And I guarantee they'll have receptive feedback to fix that. You'll see the cell in red was an error. But when we resolve the clients that didn't have any data, it gives you a company average of how many days it takes to get paid from invoicing across all clients using your historical data. Depending on your company business model, whether payment up front before performing work versus large construction, mainly doing progress billings, this can vary, so don't base it on other people's answers or other owners that you're in touch with. For progress billings, know that you want this to be 45 days or less. A quick tip I use to drastically reduce the average DSO and ambiguity in the pay when paid payment terms is negotiate adding the phrase or net 45, whichever is less, to your contract. The selling point is you are helping the general contractor get paid from clients on time as well. What happens is if it just reads pay when paid, you never will know if your client is actually getting paid or not. So you can escalate quicker knowing that you have a timeline of 45 days instead of 80 to 90, depending on your state regulations. So now we have your historical data entered. We will go to tab number 2, calculating on a monthly basis. We will calculate this using an average of your interest rates by working capital and their total balance on an average monthly cadence. The reason we don't use each specific one yet is when you're comparing general contractors, you want the data to be apples to apples across the board. And if it's too granular at this point in the spreadsheet, dialing it in too much is going to skew your data. You'll need to come up with your average interest rates among each type of working capital, and in the B column, update your yellow cells. You'll see, for example, we're using 9% annual for the line of credit, 2% for supplier terms, monthly to simulate 30 days, etc. Outside liabilities are things like equipment RPOs, small business loans, and other things that just don't fall into other categories. If we update material financing to 5%, you'll see the formulas update and how quickly it can change your bottom line. So a small increase of even 0.5% on your rates is a big difference. Next, we'll update the average monthly balance with what you typically carry at the 10th of the month as a balance for each working capital type. This helps you curate data to when the max amount tends to hit. Since typically companies get paid around the 15th to the 20th to resolve some of those balances. Now, if you negotiate better payment terms, that might be the 5th. So you might want to use like the 3rd of the month to get the best data. It all depends on kind of when your clients are paying you. It also helps to compare every company to the same numbers quickly. A side note, around the 10th of the month, you should be monitoring your expenses closely. At that point, you know that the next week or two, you should have been already paid, but now you're going to be leaning into your working capital options to continue to pay some of your labor just to keep going on a project. From there, you see the daily cost of each working capital type for the client in orange. For client number 1, which we renamed ABCGC, the line of credit portion based on the company's historical data would cost you $209.59 a day based on the balance we typically carry at the highest balance. I build in buffers like looking at the highest balance because I don't like to push company finances to the best case scenario just for the sake of winning a project. As a former project manager, I know it's a lot of variables for everything to go perfectly from the field work to payment collections to matching the estimate. But again, that's a personal decision for you and your company. You'll notice there are two credit card types. One has a 0% interest. That's for things like fuel, day to day material at Home Depot, or something like that. The other one is 2.5% to simulate the card that you use to pay a vendor purchase and adding a 2.5% convenience fee in case a supplier term is maxed out, or maybe a superintendent goes and drives and picks up material on their credit card since they didn't have a purchase order. Going to the bottom section, you can see the monthly cost of financing overall for the client based on the average 30-day month. That would be $70,352.67. This monthly percent of cost of financing is that 70,352.67 divided by your average monthly balance, all totaled together. So in this case, it's 2.15%, which daily costs you 0.07% to work with this specific client. Now, that's a lot of numbers, and you may not care about any of them, but I'm a why person, and I want to know what the data means so I understand how we got there and how credible the numbers are and what I'm actually looking at, not just hearing all of this. So next, we're going to look at the orange cell. We can change our client with all those historical numbers the same, and it adjusts the formula. So for ABCGC, with an average DSO of 34, the percent we need to add to the bid to account for the cost of capital, or in layman terms, to not pay the cost of financing the job for the client, is 2.47%. We get that by taking the daily percent of financing, 0.07%, times the average DSO of a client, 34 days. When you consider that on average, the construction industry standard is 10% overhead and 5% profit, that 5% profit is halfway eroded just because you financed the job for 34 days. And 34 days, just to put it in perspective, if you bill on the 20th of the month, 34 days isn't even the end of the other month. And most prime contractors have a 30-day agreement for their prime, and then they also get 5 to 10 days to pay you. So you're looking at a net 45 minimum is typically what you have. If we change to client 5, which is closer to the industry average with a DSO of 60, you can see the percent to add to a bid goes to 4.32%. So we're almost doing the project at cost based on the way this client historically has been paying us. And that's putting everything in perfect. To put that in perspective, doing a project where everything goes according to the schedule, everything is accounted for in the bid and properly accounted for in the bid, and we're getting paid every 60 days, not one day later, not one day earlier, but also no change orders that we can't bill for X amount of days. You could basically be doing a whole 1-year project and make $0 profit. If you add in the variables of retention, the variability of the project like we just talked about, and then change orders that take even longer to collect, you're basically paying for any project that you touch, if they pay 60 days plus. It hurts when I hear owners say, "We make money, I just don't know how," because I really can't believe it. This calculator is a tool that helps you view your finances, and it gives you data-based decision-making ability instead of going off of gut feeling and those emotional decisions from long-term relationships.